as you start to, understand that so many of us SaaS companies, a bit incestuous, we sell to each other, right? We like to live and die
Right.
with each other's tools. Well, sometimes that's one of the first things on the chopping block when you're trying to get back up free cash flow. And if you're talking about a company that has, hundreds of millions of dollars of debt on it, you're talking about going from a, prime rate of, close to 0 to 5, 6 plus. That's a pretty massive cash expense that many of us did not account for.
Yeah, I think you're right. And just to be clear, we don't have hundreds of millions of dollars of debt at
We do
Maxio.
not.
It's much more realistic and reasonable. But I have been in companies where we've had hundreds of millions of dollars of debt, and it is, you got to pay the banker. Welcome to the SaaS Builder Podcast. I'm Randy Wootton, your host, and today we're going to discuss the Maxio Institute Report. Joining me is Alan Taylor, who is our COO at Maxio. If you don't know, Maxio helps B2B SaaS companies streamline and optimize their billing, subscription management, revenue recognition, and financial operations and reporting. The Maxio Institute is the research arm of Maxio. We leverage the anonymous data of our 2,000 plus customers and more than $17 billion of billion data flowing across the platform. It's anonymized, but we use that and aggregate it. Through this, we want to give CEOs and CFOs data-driven insights, industry benchmarks, and expert guidance. Specifically, this helps companies optimize their pricing strategies, improve financial operations, and scale efficiently. Now, obviously, it's also a marketing vehicle for us, but our intention is to provide information to the broader SaaS community. Today, we're going to start by discussing the latest findings from the Q4 Maxio Institute B2B Growth Report, which you can find on our website. Alan Taylor, welcome to the SaaS Builder Podcast.
Thanks for having me, Randy.
I don't know if you had a choice, but super glad to have you on board. You've been here 6 months or so and love the leadership you've been providing, and the depth of detail that you and the team have been getting into our customer data is really awesome. So let's jump in. So let's set the stage. As we said in the Institute, the Maxio Institute report is based on anonymous data from our 2,000 customers and more than $17 billion in billing data. So it provides a broad view of the industry's health and trajectory. Before we unpack the findings, can you share how this report was compiled? Like, I think a lot of analysts out there are going to say, well, what was your N and how did you aggregate it and what caveats? So help us understand the methodology a little bit.
Yeah, of course. I mean, you talk about diving into the details, and we can't dive much deeper than we do with the Maxio Institute report. So what we do is we take the monthly billing and revenue data from about, the past, 4 or 5 years of customer data across our 2,000 customers. We take that data, we scrub it out for any sort of anomalies, we marry it with external data, such as what industry they're in, what kind of funding they've received, what sort of pricing strategies they're executing on, remove those outliers, segment the heck out of it. And, we have a lot of fantastic insights from this, because what's great about this report, it's not just observations, it's not public data. These are actual dollar amounts that are coming from the transactions and invoices that you, our customers, are processing. And through that anonymized data, we get some really cool insights on the broader SaaS industry.
Yeah, I think we're one of the few, if only, private marketplaces that is producing this. You get a lot of people doing public company data because they take the earnings and they crank it out. Our friend, I know Ray Reich does that. Dave Spitz does that. Todd Gardner does that. And so lots of people commenting what's happening in the public markets. But obviously, there's a few public companies, and they're all really big. And so I think what are the advantage of our data is we really have a lot of customers in the early stage, seed, Series A, Series B, Series C, and are able to help CEOs and CFOs better understand how they benchmark.
Yeah, absolutely. I think it's fantastic. Like, I used to be in investor relations, relied heavily on tools like FactSet, relied on competitive comps. Fantastic when you have that public data. But I've also done M&A and corporate development, and it is sometimes a bit of a shoot to try to find out what the data is on the companies you're tracking. So other than just your own anecdata on understanding what the sentiment is, it's kind of tough to understand what's happening out there with private companies. But this data helps give us, at least a little bit of a peek hole into understanding what's happening behind the public curtain.
Right on. So now if we shift to some of the learnings, I got a couple of questions for you. One, what were the key trends and developments that you observed in the B2B SaaS market throughout 2024, and maybe comment on Q4 specifically?
Yeah, sure. So, what's interesting is through Q1 through Q4, we saw similar trends, and they just continued to play out and validate a lot of our hypotheses. So the big trend that we saw in 2024 was for companies that were sub $1 million, right? That's a pretty big cohort that we like to, cut out to better understand how our startups performing. this was kind of the return to growth for them. In 23 and 22, they were struggling compared to their larger counterparts. And there were some quarters where for companies of less than $1 million, we saw average growth of less than zero. This year, that's not the case. Their average growth was hovering around north of 20%. It was better than the, competitors, or sorry, not competitors, but their peers that are larger than $1 million. And our theory there is that this really correlates to two things. Number one is, VC funds were sitting on the sidelines for a bit in 22 and 23, and they started to be deployed again. I would say probably more like back half of 23, 24. So now you're starting to see the benefit of those new funds flowing into these startups. And what do you know? It causes growth. The next is just with interest rates falling, right? That has such a broad impact on SaaS businesses, not just from a standpoint of funding and investors, but just consumer sentiment. And as we saw that improve, we started to see people taking more risks and doing business with the smaller startups and betting on innovation. The other thing as well that we saw, and I'll talk a little about some of the trends, is with AI, right? Obviously, AI is what's driven a lot of the investment, and I wouldn't be shocked if a majority of those sub-$1 million companies claim they're AI companies. But at the same time, we're seeing that AI is becoming more of a tool than a segment, right? It's a technology. And what we're seeing is companies that self-report themselves as being AI or AI first, right? Their growth rates are still outsized compared to the rest of the market, but not at a dramatic amount, right? We're talking about 15% versus 20% growth. So you're
Got it.
seeing some normalization in the AI hype cycle.
Yeah, it's interesting. Are you back to the .com cycle where everyone puts .ai after their name to benefit from the AI hype cycle? So help us contextualize a bit for the companies that are less than $1 million. What was that end? Do you have that handy?
Yeah, I don't have it handy. It's definitely in the hundreds, but
Okay.
It was absolutely a significant data set, right? In all, we have 2,000 that we're 2,000 customers that we're looking across, and within our own customer base, right? A few hundred of those are sub 1 million, so I would expect that to be the same for this report.
That's great. And people can obviously download the report and find out all the graphs are labeled with the different ends for the different segments by size, by pricing model, by region, and by revenue. So with that, you're talking a little bit about the AI companies driving a lot of growth and VCs investing in those companies. I think there's another component that you were describing, which I think is interesting, is the whole interest rates. I know for us at Maxio, we had taken some debt, and before 2022, you really didn't think about what your interest rate was and your interest payments. And I know when we were looking at 2023 and building our plan, we're like, oh my gosh, it's not about EBITDA anymore. It's like EBIT something that gives you enough cash to cover your interest payment. And that was a significant issue for us to look at, think about, and model, which hadn't been true before. So I think a lot of people got over the interest rate scare and are now perhaps the CFOs are releasing some of the purse strings that are allowing B2B companies also to invest. So not just consumers, but I think we're seeing that in the B2B segment as well as companies buying from companies in a way that they hadn't in the last 2 years.
Totally, yeah. And I think a lot of this is just hangover from 21 and 22 and what we saw with the interest rates spiking. Back in that time, I was playing an investor relations role. In 21, everything was about revenue growth. Towards the end of 21, suddenly it became about EBITDA. And then in 22, they stopped asking about EBITDA. They started asking about your free cash flow, right? And, as you start to, understand that so many of us SaaS companies, a bit incestuous, we sell to each other, right? We like to live and die
Right.
with each other's tools. Well, sometimes that's one of the first things on the chopping block when you're trying to get back up free cash flow. And if you're talking about a company that has, hundreds of millions of dollars of debt on it, you're talking about going from a, prime rate of, close to zero to 5, 6 plus. That's a pretty massive cash expense that many of us did not account for.
Yeah, I think you're right. And just to be clear, we don't have hundreds of millions of dollars of debt at
We do
Maxio.
not.
It's much more realistic and reasonable. But I have been in companies where we've had hundreds of millions of dollars of debt, and you got to pay the banker. So other than AI company, what types of companies are growing fast?
Yeah, it's interesting. And what we saw in particular, the one industry that's a big standout for us in 2024 was cybersecurity, right? Average growth rate for cybersecurity is in the 50% range. And, what we saw with that is we think cybersecurity has been a big beneficiary of AI, right? AI has made the challenges that they're solving much more complex. It's also given them the tools to be more complex in how they solve those challenges. And, the growth makes sense on face value. The other thing, though, and you'll see this in our Q3 report, right? There's some demographic, non-industry related trends that you see in the high growers. And we've got what Randy calls the trifecta, right? And what is the trifecta that you look for in being able to predict that a company is a fast grower? Three things, right? Number one, have they been able to reach 10 million in revenue? At that point, you got product market fit, you got some traction. Number two, have they received VC funding up to Series B? Right? If you've survived around, you've probably got some great fit and you got a good understanding of how to attack the market. And then number three is, have you received funding in the past few years? So are you still getting the attention of investors and still able to drive some growth with that burn? Granted, there is some survivorship bias there, but I think if you see a company that's over 10 million, has Series B announced around the past couple of years, you can bet that they're growing probably in the 30-ish% range, which is I think the benchmark that we found for that holy trifecta.
Yeah, I think that's right. And I think that is an interesting, now, granted, very few early stage companies get to 10 mil. But I think to your point, it's not just product market fit. I also think about 10 million being you have a replicable go-to-market motion. You've got salespeople, you got marketing, you got customer success, most likely. And so now you're really hitting it in terms of being able to attract new logos and grow customers. Now, granted, the challenge then is how do you scale effectively as you move from 10 to 100 million or 10 to 50 million. But in that cohort, I think we're seeing they got tailwinds.
Right.
And so other than just the opposite of that, are there other companies or industries that we found that are growing more slowly than the broader benchmark?
Yeah, sure. So first off, not a shocker, right? You have less likelihood for growth if you already have a much larger revenue base. It's just math. If you haven't received funding, or if you're a company that's reporting that you have positive EBITDA. Again, if you're not burning, you're not overspending on GTM, it's going to make sense that you have some more metered growth. From an industry standpoint, right? I think again the story goes back to AI, and it sounds odd for me to call out AI when I'm talking about lower growth. But media in particular, right? That was one of our slowest growing verticals that we tracked. And if you think about it, with AI and media, you're starting to really simplify things. You're starting to make things a bit more homogenous. And it's just made really crowded and disrupted that business model quite a bit. In some ways, disruption can be positive, like in cybersecurity. You have a lot of new challenges to solve and a lot of new tools to solve them. But from a media standpoint, right, you've cut out a lot of the complexity there with the creators. You've cut out a lot of the differentiation. And between that, there are so many new models for media as well that the industry is still trying to figure out where they're going.
Yeah, I spent many years in go-to-market tech. I worked at Microsoft in their publishing division, the MSN division, and just even seeing how that plays out in terms of people are looking for information and articles and consuming information, engaging it. And then I think there are so many different MarTech, ad tech vendors in that space. It's a knife fight, and it has been for a while. And so I do think it's marketers. And then finally, I think the whole conversation you were teeing up in terms of moving from growth at all costs to efficient growth, where people are focusing on EBITDA. Where's one of the first places that people poke CEOs and boards is on marketing spend.
Yep.
And it's tech spend, right? You want to solve for keeping the right people on the bus and having enough program spend. And so you're going to really push on the marketing tech spend. So I think that's aligned with media tech, MarTech, anemic growth. Speaking of AI, we've been talking about it already, but are there other areas that you think AI-driven technologies play in shaping the SaaS industry in 2024, other than we talked about cyber, AI first, marketing and media? There are other areas that you feel AI is playing out?
Yeah, definitely. I think we're seeing more growth in the highly regulated industries as well. So engineering tech, public sector tech, that's not a shock. But I think, more broadly speaking, right, AI is introducing brand new models to the software industry broadly, right? And it doesn't really matter what vertical you're in, you are going to get disrupted by AI, period, end of sentence. That said, in delivering AI, as we all know, as software companies, it can be a little pricey. It can be complicated. It can be different business models that we're not used to. And with that, we're seeing a lot of companies shifting into usage-based pricing. Makes perfect sense with AIs as you're paying for those, not so cheap tokens through GPT. So introducing a usage-based model makes a lot of sense for us as the providers, but also for the buyers, right? Usage-based models allow you to ramp up adoption and really pay for the value that you're seeing. And I'm a skeptic naturally, right? And I get nervous about diving into new tech. But when I see somebody that's offering something on a usage-based model or a value-based model, even better, where I'm seeing outcomes before I pay, I get a lot more confidence in adopting that tech. And quite frankly, I'm happy to pay as my value scales.
Yeah, I think just giving a plug to Ray Reich and the usage-based survey that he just did. You actually did a webinar with him recently. Really great insights, and he double-clicked down on how are people thinking about different pricing models and pricing strategy, and
Mhm.
usage-based versus values-based versus outcomes-based, usage-based commit, usage-based non-commit. I mean, it gets pretty esoteric, but I think that report is really interesting, and we'll be sharing more there. But in general, when you think about pricing strategy changes from the Maxio Institute report, what did we learn? What insights are there in terms of adoption and success of usage-based consumption pricing models compared to more traditional fixed rate models in 2024?
Yeah, it's really tough to tell because what we saw between that is, in previous years, we saw they kind of intersected, right? In 22, 23, we saw higher growth in subscription models, or sorry, in usage models and subscription models. Then it flip flopped, then it flip flopped again. Now it's kind of converging, right? And, I think a lot of that is just that those companies are starting to experiment with models, right? You see
Mm.
subscription model, you see usage model, you see the hybrid models. I
Mm-hmm.
love the hybrid model. It's the best of both worlds. You get the ARR, but you get the upside for consumption. And you get this thing that I like to call built-in NRR, which I love, and I'm sure a lot of investors love as well. And shoot, we use it here even, and it makes it very easy to articulate to customers both, the value that they're receiving as well as the value that our core product is able to provide. And investors see that as well. They see the upside and they see that, value in the subscription revenue.
Great. So maybe just talk a little bit more about the hybrid models.
Totally.
What did we uncover in the Institute report regarding hybrid models, either adoption of or prevalence of or insights of using, like at different stages in the growth of a company? What were some of the insights specifically with hybrid? Because I do
Yeah,
think the future is hybrid.
yeah, I agree with that 100%. And again, I'll throw out a plug for that report that you called out with Ray Reich and Benchmark It. And, you can listen to Ray and I geek out about pricing models for an hour if you need something to go to bed to. But, in general, it's what we found are those companies with hybrid models are actually the ones growing the fastest. And to me, it caught me off guard a little bit, but I really started to think about it. And for those people that are introducing a hybrid model, right, to me, it suggests that they have some financial sophistication and truly understanding the value of their product and their, financial commitments they need to hit. So there may be a little bit of selection bias there, but we did see that those hybrid models are growing much quicker. We can't say that one model is superior to another, though. It's always dependent on your business, how your customer perceives value, how mission critical your product is, your competitive environment. I mean, just because usage is the new hammer doesn't mean that everything's a nail. One thing in particular, another trend that we saw from the Institute report, and this one actually kind of, again, shocked me at first, but then I'm a math guy, so I started thinking of the math and it made sense. And it showed that businesses that are sub $1 million had better growth with a traditional subscription model compared to a usage model. And at first I was thinking, that's odd. If I'm a new entrant into a market, I would want to be going forward with usage models because it's a lower risk purchase, right?
Yeah.
Skeptics like me, I'm willing to take a chance on a startup if I know that I can just turn off the faucet and stop paying. But, I wouldn't read into that saying that it's a better or worse model for the down market segment because it's just math, right? You're paying a subscription fee, you got more rev rec up front. You're able to better understand, how quickly can I grow instead of focusing on driving that long-term adoption. So my personal belief is that the usage and hybrid models are going to go show better long-term growth, and it actually may show up more in the larger companies. And that is what we saw in the data, right? The larger companies using a usage-based model did better than the larger companies using a subscription-based model. So it's a plunge to get into the usage world, but the long-term dividends are absolutely there.
Great. So as we think about going forward in 2025, you also did some, this time, I think was the first time we actually did a qualitative survey in addition to the quantitative survey. That was one of your recommendations. Thought it was a great idea to help round out the broader perspective of what's happening in the marketplace. What are you hearing from, or what are we hearing from founders saying about their expectation for the SaaS industry in 2025?
Yeah, no, I loved that survey. I'm really happy with how it turned out. And the great thing is I'm looking into 2025 now is I don't have predictions or projections. I have data. So
Right.
we had about 300 of our customers respond to a very, very simple 3-question survey. All we asked is one, you going to grow faster in 25 than you did in 24 or slower? 2, are you going to be EBITDA positive or EBITDA negative? 3, do you expect to raise any kind of funding or outside capital? So we took that data, we married it with the billing and demographic data, and we got some pretty cool insights. And one thing that I liked about this is that it's really nice when the data proves out what you intuit to be true. So, for example, when I look at that growth question, it wasn't a huge shocker, right? The faster that a company grew in 24, the less likely they said they were going to grow even faster than that in 25. Again, it's just math. That makes sense. But in general, there's some resounding optimism.
Ah,
89% of people said that they're going to grow faster next year or in 25 than they did in 24.
wow.
Yeah, and we had CFOs and CEOs alike answering this. So, and
Okay, I was going to
it
say
wasn't
maybe
just
it's the
yeah.
the jubilant CEO that's the eternal optimist. No, this is going to be the year. This is going to be the year. I promise you. Okay, so people think they're going to grow more, and then what about on the? Is it going to be efficient growth in terms of being EBITDA positive, or are we flipping back to growth at all costs?
Yeah, no, again, pretty surprising, right? So, we play in SaaS. A lot of our customers are venture backed. That said, 73% of them said they think they're going to be EBITDA positive in 2025. Yeah, there's some trends in there. They're like, one thing that was interesting was there was a bit of a barbell effect. It was
Mm,
mostly the larger companies and the tiny startups.
right,
Larger companies being EBITDA positive, I mean, duh, it makes sense. You have
right.
operating
You
leverage, you're
got to.
expected to
You
generate
got
free
to. Yeah.
cash flow. But on the smaller side, even like sub 1-2 million, a lot of them were saying, "Yeah, we expect to be EBITDA positive." And I have two theories there. Number one, you got a lot of bootstrap companies that have
Mm.
no choice.
Oh,
Number two, you might have some less mature companies that have, maybe a little bit more blind optimism in their growth plans, right? And they haven't hit those scale up bottlenecks yet. So could be a little bit of that, but yeah, in that middle range, call it 5 to 20, 30 million, much lower percentages of who thinks they're going to be EBITDA positive.
and
Yeah,
that's
yeah. One
go
thing I
ahead.
want to add too is industry-wise too.
so
It
many
actually
of
tracks
us
the
as
other
SaaS
data,
companies,
and
this
this
is
is
interesting
interesting.
as we sell to each other, right?
Cybersecurity,
Like
in
delivering
particular,
those tools.
actually only 43% of
Well,
them. Sometimes that's one of the first things on the chopping block when you're trying to get back up free cash flow.
It makes sense.
And
You're
you're
talking
talking
about a company that
has,
has,
driving
hundreds
a
of
lot of
millions of
growth
dollars in
and
debt on
seeing
it.
that in the other data.
Talking about
We're
going from a
50%,
prime
prime
rate of
so
close to
totally
zero
get it.
to
Yeah,
5,
Great.
6
Well,
plus.
thank you. And
That's
for
a pretty
people that are
massive
interested
cash
in
expense
digging in
that
more, they can obviously
many of
find
us
the
did not
report
account for.
on our
website.
I think you're right. And just to be clear, we don't have hundreds of millions of dollars of debt
We
at
do not.
Maxio. It's much more realistic and reasonable. But I have been in companies where we've had hundreds of millions of dollars of debt, and it is, you got to pay the banker.